Welcome back to another episode of Selling Success. Boy, oh boy, do we have a treat in our office, podcast studio today. Wait till you meet these two amazing, good-looking gentlemen that I have in here today, and they can't wait to tell us all about what they are doing in the real estate industry. How are you, gentlemen?
We're great. Thanks for having us, Becky.
Yeah, thank you.
I was going to say good morning, but we're past that point. It's afternoon time now. It's what, 1 o'clock?
It is.
So tell me about you guys. Who are you?
Go ahead, John.
My name is John Sutton. I'm the CEO and founder of a company called Mansion Group. I'm sitting in our headquarters in Charlotte, North Carolina. And Tyler, why don't you introduce yourself?
My name is Tyler Lesneski, and I am been in real estate here in South Florida for just over 10 years, and will be the broker for our company Mansion down here in Florida.
So what is this company, Mansion?
Yeah, I could take that one. So the company's name is Mansion Group. We started it about 4 years ago in earnest, but the concept is pretty simple. Basically, we saw a big opportunity to apply a hotel-like experience, but to a secure asset class of single-family real estate. And we started acquiring single-family homes, turning them into luxury travel accommodations primarily for larger groups, so 3-bedroom or larger properties. And then we built some unique, I think, product technology capabilities along the way that we can talk more about, but that allows anyone to become investors in the properties with us.
So who came up with the idea?
Well, probably like a lot of things in real estate, there's a lot that's the same, meaning real estate investing has been around for a long time, and people, look for specific cap rates, look for specific investment opportunities and returns. And so I was actually the chief digital officer of a company called Red Ventures for about 12 years. And during that time, I started buying single-family rental properties and learned my way, probably like a lot of your listeners, into like the pros and cons of being your own landlord. Primarily, I started in long-term rentals, but I saw some of the benefits, right? I got passive income, I got tax advantages. And the homes 5 years later, I had a nice asset based on appreciation. And I saw personally that when I was traveling with a family, I had a couple of young kids, that I started preferring staying at Airbnbs more than I preferred staying in hotels. I love a nice hotel experience. I used to travel about 250,000 miles a year because I ran global operations for Red Ventures. So really the idea was myself and a couple of consulting buddies who also traveled a lot. We pooled our money together. We said, let's try to build kind of our favorite hotel-like experience, but let's put it into single-family properties. We took some of the ones that we already owned, and we kind of, I don't really like the term, but we kind of dog-fooded our own properties and said, let's figure out how to run basically Airbnbs, but short-term rentals. We call it a hotel experience in these single-family assets, and that was kind of the genesis of the business.
Where are the properties located?
Well, we started in Charlotte, North Carolina, because that's where I'm based. There's a lot of regulation and licensing required to do a bunch of the different things we do, because we actually are vertically integrated property manager and asset manager. So we have a licensed real estate brokerage in North Carolina and South Carolina. That's where we have our first 14 properties. And then we're just now expanding. Our focus is going to probably remain the Southeast for at least the next year or two. But that's why Tyler joined us to help us expand into the Sunshine States, starting with Florida, where our next property is actually in Deerfield Beach.
Okay, so tell me, what's the difference between you and Airbnb?
That's a really good question. And we do work similar on the platform of the Airbnb, but I think John said it very well. We're a little bit more upscale as far as a luxury rental, and we want to provide an experience. Like if you think of a luxury hotel, like maybe a Rosewood or a Kempton, and when you go in there, there's a certain level of service, a certain level of decor, a scent, or something that makes you think of that property of luxury. And we provide that in each one of the homes that you can stay in. So you're going to notice the same luxury bedding, the same digital experience, the same TVs, the same, so you can feel like you have a good experience at each one of these places.
So the same things throughout all of the properties?
Similar, and they'll all be slightly different depending on your geography. So maybe something in the Sunshine State may have a slightly different decor than maybe in the mountains of a North Carolina, but they're all going to be very upscale. And another differentiator that you're talking about, the difference between Airbnb and a mansion rental, is each one of our properties is going to have at least one really wow moment or one super cool feature. We're starting to see travel become, especially with Generation X, more and more in lines with they like traveling in groups. So we're talking about sharing experiences. So a group of 10 people go on a vacation, maybe 2 families, maybe it's a bachelor or bachelorette party, whatever it may be. And instead of renting 5-6 hotel rooms, let's rent a mansion property where we all can have experiences together in a really neat outdoor pool or something, as I said, a wow moment. For example, the Deerfield Beach property is going to have a pickleball court and a pool in the backyard. Pickleball is now probably the fastest growing sport in the United States. Mm-hmm. People are loving it. So that's going to be one of our wow moments for this property, a differentiator. So along with the luxury and 1 or 2 kind of wow moments like we talked about is going to be a separator for us.
What is the minimum stay?
There's not a minimum stay. I think it depends on each one of the properties, but it's what's available. So you look on a calendar, right, John?
Like Airbnb is like a minimum stay of like 3 days.
Well, so the interesting thing for Airbnb, and by the way, Airbnb is a channel partner for us. I would say like the best corollary to think about Airbnb is like Expedia. So you might go to Expedia to book a hotel, just like you go to Airbnb to book a property. So you can actually find our properties available to be booked via Airbnb. You can also book them directly with us, just like you can book the Marriott direct, or you can book it via Expedia. So like Airbnb has been a good partner to us. I don't want to say it differently, but I think I just don't want to do a comparison so people know the difference. Yeah. So I think compared to the typical properties, our properties are more consistent. That's a fact. I would say minimum stays, it does vary. We have a team called Revenue Operations. They focus on, for Thanksgiving, it might be a 3-day minimum or a 4-day minimum. For a Tuesday in the middle of the week, it might be 1 day. Our goal is to maximize the revenue potential for the property. And so we kind of balance those trade-offs. But generally, it's between 1 day and 3 days. We don't have any 7-day, 30-day blocks on our properties. Okay.
What about, do you guys charge cleaning fees and everything on top of the fees that people pay for a nightly or weekly or their stay?
We do charge cleaning fees. I know that's been a big issue with a lot of people, myself included. So because I'm the CEO, I have told our teams we pass through our cleaning costs 100%. So whatever it costs us to get it cleaned, that's what we charge. The nice part is Airbnb has actually done a pretty good job too, because I think there are a lot of people gaming the system on having low nightly rates and then surprising people with a massive cleaning fee. We've been part of the effort with Airbnb to say we're not sure this is fair for us because it looks like this person's place is cheaper, but it's not. But I would say our cleaning fees, comparatively speaking, for as big as our properties are a lot more in the $100 to $200 range max.
Okay. And you said the minimum bedrooms you have are 3 in your portfolio. What is the price range? So can I get into the nitty gritty of the business question? So what is
Sure.
What it is what do you usually purchase properties for, and where do you find the properties at? Are you looking at distressed properties and renovating them? Are you getting things that are completely renovated already and you're just wanting it turnkey? Or tell me a little bit about your process.
Yeah, I think some of the flippers are really good providers of properties for us, but we're not in the business ourselves of kind of distressed properties or renovation. So we look for turnkey properties. We look for properties, though, where we can at least get them at a fair price and underwrite our cap rates. But we typically invest somewhere between 8 to 10% of the purchase price in upfit and renovations. But we prefer that money to be going towards not moving walls, but instead of adding pickleball courts or adding pools or adding features to the property. So I would say new home builders and flippers are some of the best providers of properties to us. Because we can, at least steer the direction of some of the final touches. But target price, again, it depends on the cap rate and the geography, as you probably know as a realtor. But I would say north of $750,000. Lately, it's been north of $1 million. But kind of in that range is our sweet spot for property.
And it's hard right now here in South Florida because so many of the cities and counties have put stipulations on Airbnbs. So the city of Delray Beach, for say, it's very difficult to buy a property right now and Airbnb it. they're making it very difficult to do it as like an investment properties. And, you can do a short-term rental here is like 4 to 6 months, and you might only be able to rent it out twice a year. So I know that there's a lot of stipulations and everything going on. Deerfield Beach, I don't know. I haven't really dove into too many. I don't really sell Airbnbs, so it's not really. I only know because I had a big client in Delray Beach that picked up 5 properties, and he Airbnb'd it, and the city really came down to him.
Yeah, each city is completely unique.
Absolutely,
as you know,
city and county. So
yeah, and so you have to just be very mindful when we're doing our research. We have a formula of how we find properties that are going to be a good investment for our potential clients, and obviously, finding out what the rules and regulations of each municipality is a big deal. Deerfield has been very, very Airbnb friendly. Parts of Boca, yes, no, depends. And each city, like you say, is completely different. Obviously, we're not going to be in condominium buildings or things. We're a single family home base. So at least we don't deal with HOA presence. And HOA can have a lot of factors on that. But the properties that we're doing are non-HOA and single family homes.
So what cap rate do you look for, and how do you figure out your cap rate for your business?
Yeah, so our target cap rate at a minimum is 7%. That's what we look for when we're
pretty high on an Airbnb. 7-8%. Yeah. I feel like that's high. That's good.
The nice part is we raised $1 million fund for our first fund, and that exit cap rate is probably going to be north of 9.5%. Entry cap rate was around 7%, and so I think that's where we're going to try to hold the bar. I think, for us as we're growing, we can be disciplined. And I think we have to be for our investors and for ourselves. So we may have $25 million we want to put to work buying new properties, but at the end of the day, if we can't find the properties that will generate the returns we want, I don't think we'll lower that bar. But that's our target. The way we look for a property though is generally, we have what Tyler talked about, our approach, and we have some unique data sets that let us project expected revenues based on amenities, based on location, based on competitive sets, same stuff you would do as an appraisal, basically, except we can do it with short-term rental revenue data, which is I think somewhat new. I don't know if it's unique. I think other investors are doing it, but with that data, the minimum we would look for to generate that 7% cap rate is probably to see somewhere around 15% of the purchase price in gross revenues, if that helps you.
How do you figure out your math? So you have to come up with the price for you, so this is the investor cap on me now. I work with a lot of investors. So you figure out a nightly rate that fits the need for the price per square foot or the bedrooms or the area or the location. And then you do that, you times it by however many days, and you know that that's where you need to be at number wise? Or how do you do your calculations? Just curious.
I think what you were starting to say was spot on. We have metrics to see what in that specific, not only town, city, but maybe neighborhood, what is our competition looking like? And we have data subsets of what the average Airbnb for a 3, a 4, a 5 bedroom will be. And then, of course, we have our own set of matrix that we use depending on certain qualities or qualifications or amenities that we have that may fluctuate the price and what we think we can get per night. And that's the gist, I'd say, of our data points.
Yeah, I'll share some interesting tidbits for your audience, but I think that's right. We look at average daily rates, expected occupancy in that specific property, and then we have some kickers for amenity adds, right? So I just pulled data for a recent SEC filing. We're seeing about north of a 20% revenue increase by having a pool in South Florida. Mm-hmm. So, right. And then, okay, that's revenue. Now we have to offset it from maintenance expenses.
Exactly.
Okay, what's the maintenance expense? And so our underwriting models try to account for all of those things, but adding a pool in North Carolina actually doesn't add that much value.
Right.
And so we try to kind of have as best we can an understanding going into it, and then we'll prove it at some scale, we hope, get better. The more properties we add, the more times we can learn. But yeah, our underwriting matrix is pretty simple. Purchase price, upfit cost. In Florida, we got to look at property taxes and insurance costs as an offset to those revenues that may be different than North Carolina. Mm-hmm. But at the end of the day, it's a cap rate for our investors, an expected IRR. Today, we're not buying with leverage, but we have the ability to refi to kind of return capital earlier to our investors. And yeah. kind of the approach.
So is this business, are you looking for investors to buy into your business, or are you looking more to, what exactly, where are you guys at right now in your business planning with this, the mansion? Because I know that it's just now hitting the ground. So what exactly are you looking for? Are you looking for investors? Are you looking for people to rent the properties? What exactly are you looking for right now in the business?
Well, we're always happy to have more people book directly with us, but our operations in terms of bookings and stays is pretty healthy. So we're not actively marketing or looking for more people to stay on our properties. But like I said, always happy to have more people book them. But actually what I think the unique innovation we launched was seeking investors that want to invest in real estate. So not the operating company. So at the top of it, think of us as like an operating company. That company, Tyler and I work for, that pays our salaries. We're the property manager. We take some investment management fees, pretty low fees compared to the market. But then we are raising capital. And we decided there's really two ways for us to raise capital. We have an accredited investor fund that is specifically for accredited investors. Like that fund will acquire real estate, like we just talked about. That's our target real estate. But I think uniquely for Mansion is we went through what's called a Regulation A process with the SEC to qualify an offering that actually allows non-accredited investors to invest in real estate, specific real estate properties alongside us. And that the minimum is $100, different than our accredited funds minimum is $25,000. And so that was a process, took us about 12 months. And we did it primarily because we had a lot of guests who would stay with us for a night or for 5 nights. They wanted to kind of have that mansion-like experience. They probably couldn't afford to have it every night, but they could afford to pay $500, $600 for a weekend. And they didn't know that they could invest in real estate. Like I think a lot of people without a ton of disposable income don't have that access. And so, yeah, we spent almost $500,000 building the technology, the product, and the regulation process to open it up for investors. And that actually launched about a month ago, the ability for people.
Okay, I'm interested in this. So tell me a little bit more about this. You said as little as $100. It doesn't even make sense. That's very small.
It is very small. I mean, the idea is not different than a fund. So like traditionally a real estate fund would go try to raise $10 million and they might do it with 100 people investing $100,000, right? So it's a fractional, like you own a share of that fund. What we did is we took a pretty unique process with the SEC, like I said, called Regulation A. And basically what that allowed us to do is to crowdfund. So we've all seen crowdfunding sites out there. But instead of crowdfunding for Mansion Group, we actually take a single property, we put it in its own LLC. It becomes its own little mini company. And then we sell shares of that LLC. And that's what.
So each property is its own LLC.
Yes.
Correct. Yeah.
Well, why? I'm just curious as to why each individual property is its own LL. Why would you do that?
Well, so primarily
because I have huge portfolios, and they're like, I have them in trust or whatever it might be. But I mean, I'm just curious as to why each individual property is its own.
Well, so a couple of reasons. One is we wanted to limit the liability as specifically as we could.
Okay.
So if somebody calls it property 2 and they're all under the same LLC, then all properties are at risk of liability. So that's one key reason. But specifically for the Regulation A, it's because we wanted the individual. I believe real estate is as much emotional for most people as it is financial. And so I didn't see anyone out there like a REIT. When you invest in a REIT, it's like this blind thing that might buy mobile home parks and storage units, but you're really doing it just for the financial returns. I wanted to try to tap into like the people that go to Zillow to dream about their next house and give them the opportunity to say like, you can keep dreaming, but you can also invest to try to build your wealth to get to that point. And investing in real estate is one of the best wealth creators, like in the US in particular, but probably in the world. And I just felt like it wasn't available to as many people as it should be. And my background is consumer marketing. And I felt like this played to our strengths. Let's see if we can democratize this investment opportunity. But to answer the LLC question, it's both the liability side, but also we wanted people to be able to pick a specific property. And to do that under SEC rules, we needed to make that specific property its own company.
Interesting. Smart. So there's somebody here that it's called IPH. So they have IPH and they just name each property is called IPH. But as you go down, there's IPH 33, IPH 35, IPH, and they name each property, each different thing. So I just wanted your take on it. He does it solely for the liability. So he has a bunch of tenants in there and it's low income. So he has it all each individually owned. So I just wanted your take as to why you individually did them as opposed to doing it all as underneath one.
Well, I think John was really getting nailed to the head was, we're in here trying to pay and trying to make money for our consumers and for our clients. But the emotional side is just as important. So as John was saying, so many people go to Zillow every day and start dreaming about the next house they can have, where they can go onto our website and say, oh my gosh, I'm looking at 5 potential investment opportunities. I really qualify with this one. This one hits my senses. I love the outside. I love the pool. I want to invest in this one property. And instead of calling it P36 or P37 like your other investors, we for example, our Deerfield property will be called the Pickle Cove. So it's located in the Cove and it's going to have a pickleball court. So it's going to be called the Pickle Cove. And when someone lives in this community and say, wow, I own part of a real estate in my own community of Deerfield Beach that I live in. And maybe that's their emotional draw, right? Maybe another emotional draw is they like something in the Carolinas and they want to invest in that. So they can feel a little bit more emotional and then it creates loyalty. So maybe they could tell that, hey, mom and dad are coming down. They need a place to stay, or my friends are coming down to visit. Why don't you stay in one of our properties that I own a share of in my own backyard? And I think that's a little bit of the advantage as well.
I was going to ask you, what are the advantages of being an owner other than financially down the road and them getting a share stockholder money on it? What makes it, do they get like a weekend or do you add any perks for people to invest in the property?
Well, currently, no, because we could argue that wouldn't be ideal for the entire portfolio if we started giving people discounts, owners, because most of these properties are booked anyways, and we're trying to get the best ROI for our people. So by giving discounts to the people that own it wouldn't prove to be beneficial. So if you owned a share of Apple, you don't go into the Apple store and say, hey, can you give me 10% off my phone because I bought a share in your company today?
Right. I'm thinking more along the lines of like timeshare. Right. So you own a part of the building, you're paying for the property taxes, you're paying for the dues. So, but you also get a perk of like a week.
Yeah. We don't look at it as a timeshare. We're looking at more like, as I said, more of the Apple model where you're owning a share of a stock in a company. And then we're trying to do our best to perform for you for an ROI. Okay, no, good. You absolutely can come stay in one of the properties. And we hope you do. But maybe things will change in the future, but I think that's the direction we're going now, John.
Yeah, 100%.
Mm-hmm.
Where can people...
We get the timeshare question a lot, by the way.
What is it?
You're not alone. We get the timeshare question a lot.
Well, because it's like you're in between, right? So you're in between like a timeshare and an Airbnb. And me being in real estate, I'm going to ask like these questions because I know that my people, my clients, my customers that are listening to me, these are the questions they're going to ask me. Yeah. Or they're thinking it. What makes this different than a timeshare? What makes this different than an Airbnb? What makes you guys stand out differently than the other portfolios that are going around right now?
Yeah, great questions. And we get that timeshare question all the time. But again, it's you're owning a share of a stock and it happens to be real estate. That doesn't give you the opportunity to get discounts when you stay.
Okay. I had to ask.
Yeah. We get that every day.
So where can people rent it or where can people invest? Where can they find out this information from?
Yeah. So like I said, definitely prefer that you find and book a stay with us either in our mobile app. So on the iOS and Android store, we have a mobile app called Mansion Life. You can download that. It's a simple way to do it and get access. And we provide concierge services and we can fill your mansion with groceries before you arrive and a bunch of other things. Our website is mansionlife.com. The idea is enable anyone to live the mansion life. On the site, you can actually invest. So there you can, like Tyler was sharing, you can see the properties we have available for investment, go through the process. You can read all of the details in our filings with the SEC. My lawyers would be happy that I share that with your audience, but you can find those on the site as well. But yeah, both are available on the website. Book a stay, invest, browse the property, join one of our webinars if you want to learn more. So there's a bunch of content up there.
So where do you guys go from here? How big of a portfolio do you think? You're at 14. You said you're purchasing your 15th one right now?
Correct.
So how many more properties are you going to purchase? And we'll say within the next year, where do you see this growing to?
I'll tell you our aspirations, but like I said, I think we'll keep the bar high. We're going to go raise a $25 million fund to acquire real estate. Separately, we're going to continue to have these retail offerings. Those probably will be around once a month, maybe a little more frequently, but we'll offer a property to the retail investors as well. Our goal for next year is to try to get to 75 properties in our portfolio, which is pretty rapid growth for the team. That will be spread across probably around 6 markets, primarily in the Southeast. But that's our 2024 plan as of right now. But again, because the real estate space, we got to be somewhat reactive to what changes in the space. But that's what we told our investors, and that's what we have on the books.
What are you doing to grow your investment? What are you doing to grow your investors? Because you said you want to raise up to $25 million for the year.
Yeah. So on the REIT fund, we're just kicking that off. So we're just formulating kind of the final accredited investor fund docs. We're kicking off that fundraising process really in earnest after Thanksgiving. We would expect to probably close that fund by, if not by the end of the year, by January, kind of mid-January. We're connected to a lot of family offices who are going to invest in the fund, but it is open to any of your listeners that are accredited investors. They can schedule time with me or investment team. On the retail side, probably all the stuff you would typically think of with a direct to consumer. So we participate in content marketing. So we do podcasts, we do organic social, we do paid social. So actually Facebook, Instagram are a great way. I think our marketing team is doing a good job of putting creative out there that helps people at least be interested in real estate investing. And I think hopefully have that wow moment where they don't believe they can invest for $100. So that at least is driving some intrigue at the top. And then, we'll see what next year looks like. But on the retail investor side, I think that's where most people will see us out there publicly. On the accredited side, it's a little bit more kind of working our networks and our book.
So what book are you writing a book?
Our book of business.
Oh, your book of business.
Yeah.
Well, you said podcast. You guys have a podcast?
No, just being.
You're just being on guests. Okay, because I see that you have a microphone there. I wasn't sure if you guys had a podcast that you wanted to plug.
I bought this just for you, really, because I had bad audio last time.
Oh, really? Well, it sounds really good. So it works. It works. You'll have to go on a bunch of shows, and I'm going to interview you guys in 6 months, and I want to do a checkup to see where you guys are at in the business wise.
We'd love to.
I hope I'm breaking all those numbers I just told you.
It's amazing. You have to shoot high. You have to shoot high. Here, everyone's worried about the market. I don't know how it is where you're at, but here in South Florida, I have a lot of buyers. I have a lot of investors that are worried about the market. I tell my investors every day, I hope for you guys, it downfalls like everybody is saying that it's going to, because we're going to scoop up all these properties. It's going to be amazing. If the market crashes, my investors are they're just pigs getting fat. Yeah. They're just getting a whole bunch of people that are renting that they can't buy. That's not obtainable for them. And we're getting top dollar for rent even right now.
I mentioned, what's your take on that, on the real estate market in general? What do you?
I don't see it crashing. My own personal, here in South Florida, it's still a hot market. I've got a couple properties coming up for sale. A ranch that's 30 acres for $8.5 million. I have a feeling it's going to go very, very fast. And I've got another house on the Intercoastal that I think is going to move very quickly. If the property is priced right, I feel like things are moving very quickly. If the properties here in South Florida have a pool, it's most likely going to be gone. If the house it doesn't need a whole bunch of work, and if the roof is not original, they're moving very quickly. And I'm also having sellers enticing the buyers to buy. We're negotiating, instead of us negotiating off the purchase price, we're actually negotiating a percentage back towards closing costs. So then it's going to lower the interest rate. So we'll take an $800,000 house as an example. We have an $800,000 house. We're going to ask for 5% back instead of off the purchase price. I'm going to give them full ask at $800,000. And I'm going to ask for 5% back towards closing costs. So now I just brought the interest rate of that buyer from 7.5% now to 5.5%. The life of a 30-year mortgage, you're talking about savings of $320,000. You know, and then on top of that, your monthly payment's going to be $400 cheaper. Those are just tips and tricks that I'm using right now. But I do feel like, I don't know. Here in South Florida, it's still a crazy market. People are still moving down. We're now going to get a huge influx of everyone from California. So, you know, we just had a big tech guy move here. I don't know if you guys know. We had a big tech guy move here to our coast, and he's moving his entire team here, and it's going to be insane. And I think that's going to be our next. We just had New York and New Jersey, Connecticut, and now I think our next influx is California. So I don't know. I wish I had a crystal ball. I do feel like it will soften some, because I feel like we got to the point of like it being completely and utterly ridiculous. But I feel like, are we going to see $200,000-$300,000 decreasing on homes? No. Would we see anywhere from like 50 to 75? 100%. That's my own take on it. I would say over the next couple years that we'll see that. But I feel like the next surge of buyers will be these renters that are going to get priced out of their rentals. They're going to have to buy.
Yeah, if we look at statistical data the last 20 years, whether home prices go up or down, rents have continued to go up no matter what happens with the price of the house. So you're right, there is going to be people getting priced out as far as rentals go.
I mean, I can't see it any other way, you know? And if interest rates go down, it's going to be a feeding frenzy again.
Completely agree.
That was my worst time in real estate. So everyone's like, did you make millions during that time? I'm like, honestly, I'm fighting against 80 other homes. And I've been in real estate for 21 years. My parents have been in real estate for 40 years. So for me to like sit there and tell somebody they got to give their firstborn child to the seller, I have like such a hard time ethically doing that. Cause I'm like, I don't know, guys, maybe you wait until the feeding frenzy's over. You know, I'm not one to do something because it's a trend. Houses are selling. I'm like, okay, let's hold back for a second and let's see what's going to happen here. Or when things are slow in real estate, I'm like, we buy. We build our portfolios. I work with a ton of investors. So I stock the market. And when I see something coming up and I hear about something coming up, I let my investors know first, and we scoop them up really quickly.
That's smart. Yeah. I mean, listen, I talk to a lot of investors on a daily basis, and I always get the question on like, oh, what happens if home prices go down? I'm like, where we are in our life cycle, that would be great. Now if home prices 5 years from now, when we're trying to exit, go down, that might be bad. But I mean, I think the nice part is, for your investors and for accredited investors, I think they can have that long-term lens, which is really the right lens to have for real estate investing. And, I tell my sister, who's maybe not as avid of an investor, like her best investment has been her own personal home. I think that's most people, by the way. And it's because it's a forced holding, right? Like the challenge with retail investors that I've seen is like too many platforms like the Robinhoods of the world, et cetera, like allow you to believe that like you have this magic touch of trading. But like data would suggest that like the people that try to trade and time the market always lose versus those who hold. And so like, it depends on your time horizon. Now, sometimes life happens and you have to liquidate, but our goal for our investors is to say like, our time horizon is 5 to 10 years. Like a typical exit would be 7 years. And we're going to just do what you do, talk to experts like brokers like you, see what they're saying about the market, use our best judgment, and exit the property like in a time that makes sense. Now we look at other things like when are we going to have to replace the roof, when are we going to have to replace heaters. But, I think just the education of podcasts like yours and others, and hopefully what we're going to do with Mansion is just like educate a whole nother generation about real estate investing. And
it's huge. I educate, I do a lot of like first buyers seminars to try to educate, people that don't think it's obtainable to own real estate, and I'm like, you need to have playing cards. You need to be able to have a house in order to go up. They're like, but I don't like the houses in my price range. I'm like, you got to start somewhere. Yeah. You need to have those playing cards to trade up and keep getting bigger and bigger and bigger. My first house was a 2-bedroom townhome. And then I used that to buy a 3-bedroom. And therefore I used that to buy a 5-bedroom. And then I kept my 3-bedroom, I rented it out and kept it as a portfolio. And then now in real estate, it's like, I don't sell my real estate. I keep it, I hold it, I rent it, but it's like everyone's different, but you need those playing cards. And then when you're at the point where you have the house that you want, like I'm very happy in my home now. So what I do is I've got a very low interest rate. I do have a mortgage on my home. contrary to what people believe, because the only reason why I have a mortgage on my home is it's for 2.2375. So I'm not going to spend money that I have in the bank when I'm paying such a low interest rate. And that's another trick I tell people. Interest rates are low. I know you've got that cash. Keep that cash. Go invest it somewhere else. But when interest rates are so low, it's almost like a seal. We want to use the interest rate on that and put your money elsewhere.
That's right.
So it's like I just try to look and leverage my money exactly and help my clients, because I work, like I said, with a ton of investors. So I've learned throughout the years of, the tips and tricks in real estate. And when the real estate market, the interest rates go down, I'm like, cash out, everyone. Go get the money and we're going to go buy your next thing. Yeah. So I try to help everyone utilize their money properly in the market.
Yeah, listen, I think like you, I don't give investment advice, but I don't think anything we're saying is investment advice, but I think the same way, right? Which is, if I can get money at 2% and I can earn, like our real estate investments earn 8%, I'd rather earn the 8.
Exactly.
Pay the debt on the 2. So I think you and I think the same on that front.
Yeah, 100%. So where can everyone find you guys?
There you go.
So how could they is there a number, like a 1-800 number to call, or is it are you guys only strictly based online right now?
No, so I'll give out the 1-800 number if
Sure.
you want to call. So there's a 1-800 number. It's 1-855-966-4262. You can connect with any of our investment team and hear more about Mansion. Like I said, mansionlife.com. We have our chat bot that's up 24/7, but we also have ways to reach us, webinars, and you can just invest directly. It literally takes less than 3 minutes to create a profile and invest $100 if you want to give it a try. Our first property is up now, the Pickle Cove, which is the Deerfield Beach property, is coming shortly. And I think that's probably the best resource. And you can also find us on all the social. Our handles, Live the Mansion Life, or connect with Tyler or myself directly. I'm fairly active on Instagram, LinkedIn, and X. So happy to chat with people.
Absolutely.
What is one good tip you guys would like to tell my listeners about your business?
That's a great question. I would off the cuff, I would say anybody who has been really wanting to get involved in real estate and don't think they're able to financially, here's their opportunity to dip their toes in the pool.
It's a good start.
Just like you said, you may not be able to have everything at first. You got to start somewhere. Mm-hmm. And for anybody who's been wanting to invest in real estate, here's your opportunity for a low entry barrier.
Of $100. Can we just say that again? It doesn't even make sense. Of $100. It's insane to me. Yep. That might change in the near future. I can't imagine that that's going to be obtainable for long. I think your minimum is going to have to be from a business aspect.
We know higher. That we will likely lose money on the $100 investors, but we think over the long run, just like we're telling, I think we try to live what we preach, which is that person who invests $100 once, we hope they'll invest $100 whenever they can, every 6 months, every year. And over time, just like an asset manager, if you're a 21-year-old, that would be my advice, right? I wish I could have told 21-year-old me, and I was lucky enough. I sold my first company when I was 22. I got a pretty good paycheck. We sold the company for a couple $1 million. And
at 22?
At 22 was my first company, yep.
I started my first company at 22. I didn't sell my first company, but I started my first company at 22.
I was early to the web. I liked that part of it. It was a high-end audio video company, but I didn't invest in real estate other than my personal property. I didn't invest even a little that I could have. And now that I'm 41, going to be 42, just $10,000 invested at 22, compounding over the last 20 years would be a material amount of money. The same is true though, right? Compounding works the same on $100 as it does $10,000, right? The compound effect. And so that's what I would say is get started. If it's money you wouldn't notice, whether it's put away $100 a month or $100 every 6 months or $10,000, whatever it is for you. I think sophisticated investors learn that sometimes later in life, like myself. But I wish I'd learned it sooner, and hopefully we can help a generation kind of get started at least.
Absolutely. So to all the grandparents that are listening to my podcast, this would be a great Christmas gift or a holiday gift for your grandchildren. Set them up. Let them know how important real estate is. A couple $100. And what do they get when they buy in? What do you give them?
So You get shared, you get a certificate. That's a really good idea, though. Maybe we'll make like a little gift.
I think, you know what I mean? Like,
good idea.
I'm a mom. I've got 3 kids. So for me, it's like, that's where my head goes. Like, you want to build your kids up. Here's a great buy-in for them for a holiday gift.
Oh, maybe we'll make up something. We actually have a close friend who works out of our offices who makes like physical things. I wonder if we could make a representation, Tyler, something they could wrap, but that shows that they own 100 shares or 10 shares or whatever it is.
I love that idea.
You know, like back in the day, like when we were kids, our grandparents would get us savings bonds.
Yeah.
Same thing.
Get a share of a mansion for Christmas.
Could you imagine? And like a picture of the house and like, this is what you own in. You own part of this.
It's a really cool idea.
We're going to build that in the next week and I'll send you your first gift.
Awesome. Yeah. I have my oldest is 21. I'm 41 as well. I had my son when I was young. He's 21. I was thinking about it for him. You know, buy him a couple $100 worth of a mansion. You own these 5 blades of grass. 5 blades of grass.
Every blade counts.
It does, especially here in Florida.
I didn't think we mentioned we also then do dividends for our investors.
Yeah, I mean, just like your real estate investors. I guess we didn't get into it, but yeah, if you own 100 shares, we pay quarterly dividends. Mm-hmm. So even if your dividend's 25 cents, you'll get your dividend. And we pay quarterly dividends, and obviously you participate in appreciation. And right now, like the plan is, you should look to hold it, but we are looking to provide liquidity options for people that need it. And then we're gonna work to build a true secondary market to let people buy and sell shares of our property. That probably is at least 2 years away, though. To be fair, and it may never happen, as my lawyers would like me to say. But
they want you to say it may never happen.
You should read the offering circular and realize what lawyers want you to say as it relates to investments.
They have a very negative mindset.
They like to say risk protection. Let's put it that way.
Yeah, risk protection. When everything is a risk.
Absolutely.
Walking outside is a risk. So, I mean, I don't know. Real estate to me is not, maybe because I'm in the field, to me, real estate feels very secure.
Same.
So it's just where I'm at in my field, in my life. But I'm so happy I had you guys on. Sorry, I picked your brain for like the last, 45 minutes?
No, we really appreciate it. Thank you, Becky.
Thank you guys for coming on, and let everyone know, are you guys on social media personally or just business wise so they can look you guys up?
Yeah. Personally as well.
In case they want to pick your brain or invite you guys on their podcasts.
Sure. Yeah. Mine is Tyler_Lesneski, and we can put a link up there or something.
Yep. We can definitely put a link.
You can find me on X or on LinkedIn.
What is X?
_ John Sutton. Twitter or LinkedIn.
Okay.
Yeah.
Okay. I'm not on Twitter or X or whatever it's called. Well, thank you, gentlemen. I really appreciate it.
Thank you, Becky.
Yeah. Thanks, Becky. Appreciate it.
You guys, I hope you guys have a successful week, and please tune in on all your Apple, Spotify, and where you listen to your podcasts. Have a successful week, guys. Take care.